Welcome to the fourth quarter 2018 United Asset Strategies Market Update. I am Lee DiLorenzo. I'm the President and Chief Investment Officer of the firm, and I'm joined today by Thomas F. Healy III. He's the architect of our Value Plus strategy and our ESG strategy, which stands for Environmental, Social, and Governance. Tom also covers politics and energy. Today is Thursday, January 10th. And this webcast is being recorded. Please keep in mind this material represents just an assessment of the market environment at today, this point in time. Well, looking at 2018, we saw stocks move down sharply in the fourth quarter. They have the dubious distinction of triggering a bear market. And a bear market is when the prices drop more than 20% from their high, which did occur in the S&P 500 and the NASDAQ. For December, we just want to look at the change in market price, and we want to forget all about it. We saw a 9% drop, which was the worst since the Great Depression, and the move down on Christmas Eve was also the worst on record. And returning to volatility, our old friend, which we spoke about in previous recordings, not only did it keep up, but it accelerated. We saw double the 5-year average in the last quarter of 2% daily moves. And for the year, we had more than 2% daily moves than the sum of the last 5 years together. Over the long term, the average of volatility is the move of about 0.75% a day. And the mathematic requires us that we were so far under the average, we have to overshoot to just get back to historic levels. Finally, I do get to speak to some good news that valuations have improved meaningfully. One of the most popular metrics for determining if a stock is overvalued, undervalued, or at fair value is looking at their PE, the price to earnings ratio. And we can look at trailing, current, or projected PEs, but by any method, the drop in stock prices that we have experienced over the last quarter and December in particular has presented us with a much better entry point for many companies. But to determine if the coast is clear, we'll need to look forward into 2019. And for this, I'll turn the mic over to Tom Healy.
Thank you, Lee. As we look to slide 7, one key issue we're watching is the current trade talks with China. While the tariffs imposed in 2018 had a modest economic impact, we think that could change in 2019 if the two sides can't come to a compromise during this negotiation period. On the left side of this slide, you can see the benefits of fiscal policy, meaning tax cuts, higher government spending, that were significantly higher than the cost of the tariffs. For example, you could see that in 2018, fiscal stimulus was estimated to be $1 trillion, where the tariffs were impacting us by the amount of about $30 billion. But as we look to 2019, this reverses, and there is a potential that negative impact of tariffs could be larger than the positive impact of fiscal policy. This could present a headwind to the world's two largest economies. We're watching this closely, especially as economic growth seems to have peaked in 2018. This is illustrated in slide 8. In terms of the economy, this slide shows the strong growth in the most widely watched measure of U.S. and global manufacturing activity from 2016 through 2018. While global growth peaked in early 2018, it now appears that U.S. growth also peaked in the fourth quarter. While this metric still points to an expanding U.S. economy, that rate of growth is clearly decelerating. Proof of this deceleration can be seen on the next slide as well. Here we're looking at U.S. GDP growth. As you can see, the growth rate accelerated from 2016 through 2018 on the heels of strong corporate earnings, tax cuts, and increased government spending. Looking at 2019 and 20, the consensus is calling for a deceleration, although GDP growth isn't expected to experience negative growth. What's worth noting is the level of growth in 2019 and 20 can still support positive equity markets, as evidenced by the 2009-2015 period where markets rose on the back of modest U.S. GDP growth. The recent market decline reflects in part the reality of this deceleration. This dynamic is also true of corporate earnings, as we show on the next slide. Similar to the trend shown on the previous slide, we would expect corporate earnings to normalize in 2019, with operating earnings expected to grow 6 to 7% and EPS, due to the benefit of stock buybacks, up roughly 8%. The year-over-year deceleration is driven largely by the cycling of the tax cuts, which boosted results in 2018, as well as the impact of lower oil prices on the earnings of companies in the energy sector. There is a silver lining with the cooling off of the U.S. economy and decline in oil prices. That is the impact on inflation trends. On slide 11, we take a look at inflation as measured by core CPI. As you can see, the growth rate appears to be range-bound, and the upward move in late 17 through mid-18 has reversed as the economy slowed and oil prices declined. We think this is critical as the slowing economy and range-bound inflation outlook takes pressure off the Federal Reserve to continue to raise rates aggressively. While markets were previously discounting 4 rate hikes in 2019, we now believe that 1 to 2 hikes is more likely. While the direction on monetary policy may be supportive of equity markets, we see a very different dynamic in the world of politics, where we are currently mired in what will be the longest government shutdown in U.S. history as of January 12th. As we look into 2019, we think the current level of partisanship will only grow for the next 2 years, as Democrats have now assumed leadership of the House of Representatives and the House committee chair positions. Several of those chairs have already indicated that investigations into President Trump and his administration are likely over the next 2 years. We also think getting anything done just got harder as we look to the graphs on slide 12. First, we see the second largest freshman class since 1967 taking office this month. Typically, new lawmakers come in with their own ideas and are less likely to fall in line with leadership, making it more difficult to get things done in Washington. On the right side, we see the lack of party diversity at the state level speaks again to the rise of partisanship, which is usually not conducive to compromise. A most critical issue to watch is the debt ceiling. In February 2018, the president signed a bill suspending the debt ceiling until March 1st of 2019. The debt ceiling has been increased 10 times over the past decade, and this is necessary to avoid having the U.S. default on its debt. The last time we came close to default, the U.S. lost its AAA credit rating. Rating agencies are already warning that the U.S. government credit rating could be reviewed for possible reduction if debt ceiling negotiations move close to the March deadline. And as you can see in the slide here, markets do not like debt ceiling debacles either. Again, this is just another issue we're watching closely. So those are some of the critical issues that our investment team is assessing as we look at 2019. And with that, I will turn the call back to Lee.
Although we have several yellow lights flashing, we have had some improvement in many metrics. But the return to volatility has definitely affected our clients' risk tolerances, and we do need to hear from you to make sure that we have you in the right investment buckets. We encourage you to check in with us regarding your known cash flow needs for 2019 so that we can secure sufficient liquidity is on hand inside of your portfolios. So in closing, we want to wish you and your families a very happy, healthy new year, and we invite you to stop by our new offices, which are also located in Garden City, and we move in on Monday, January 14th. Thank you, and we look forward to a prosperous 2019.